Hello, I'm Bernard Hickey with the daily briefing from interest.co.NZ. Today we'll look at the latest house price figures showing price falls, volume falls and a blowout in the time taken to sell a house. That news just in. We'll see what Helen Clark's plan for shared equity mortgage schemes might mean for the housing market. We'll cover a few snippets of economic news and the current outlook for interest rates and the exchange rate. And we'll detail the latest news in finance companies, including the latest from St. Lawrence, money managers and MFS. Firstly, we have news just out showing house prices nationally fell 1.5% in January from December. Real Estate Institute figures also show the volume of houses sold in January was down 31% from a year ago. And this is the ominous one for people who have just put their houses on the market. The time taken to sell has risen to 49 days in January from 36 in December. That's the worst it's been in 6 years. The housing bust has just started. Now, you might have heard on Tuesday that Helen Clark is proposing a shared equity mortgage scheme to help first home buyers get into cheap houses. It's supposed to address the housing affordability crisis that's developed in the last 5 years since house prices more than doubled. The idea is that either a bank or the government would take an equity stake in a house being bought by a first home buyer and share the equity gains as the house price rises. The theory is then that the home buyer won't have to save so much of its deposit to get into the market. This really is just mucking around at the fringes, I'm afraid. A similar scheme has been launched in Australia by Adelaide Bank, but it hasn't really caught on. A second scheme was actually cancelled in Australia yesterday. There's a couple of problems with these schemes. Either the buyer doesn't really want to give up the capital gains, or the bank doesn't want to get into the business of betting on house prices. The other problem we see with such a scheme, one that will be faced in New Zealand, is that house prices are likely to fall in the next couple of years. So any bank is unlikely to want to share in growth in negative equity, and it's not something most voters would want their government to be doing either. This policy, I'm afraid, is really a headline in search of some sustainable detail. The affordability problem is not a demand or a financing problem. Most people have no trouble getting a 90% or 100% loan these days. It's just they can't afford the repayments. Getting the bank or the government to take a 10 or 20% stake is unlikely to change that much. The real problem is a supply one. There simply aren't enough new houses being built to keep prices from rising. And to be fair to Helen Clark, in her speech yesterday she spent a good chunk of time addressing the problem of supply, and she has promised a review of how much land is available for new housing, particularly in Auckland. She also wants to free up government land for new housing. Now, both of those things are good, but it really is too little too late. Housing is 30% overvalued, we reckon, and the only things that will reduce that are a housing property crash, a slump in interest rates, a boom in wages, or a boom in house building. The most likely outcome in the short term is a drop in house prices. That started in January. Next, we take a look at the latest inflation data, and it's a big worry for the Reserve Bank and therefore the outlook for interest rates. The so-called Producer Price Index numbers came out on Wednesday, and they show the prices for businesses, in particular their input prices, it's essentially everything that's not labour, and their output and selling prices. The Reserve Bank likes to watch it because it gives an idea of the likely inflationary expectations of businesses. The figures show input prices rose 4% in the December quarter from a year ago. Now that compares with an annual rate of 2% in the September quarter. Meanwhile, output prices rose 3.4% in the December quarter from a year ago, and that's more than double the annual rate in the September quarter. Both of these numbers for output and input prices are above the Reserve Bank's 1 to 3% target range. They are likely to increase the chances of a rate hike when the Reserve Bank next releases its decision on interest rates. Whether we get a rate hike on March 6 is a tough call, but it doesn't look good, particularly if, as expected, Australia hikes its rates 2 days earlier. The only good thing is this fall in house prices, which should take some pressure off the Reserve Bank. And finally, a roundup of news in the finance company sector. St Lawrence Property and Finance has announced it wants to raise $24.4 million to fund a couple of developments in Wellington and have cash on hand to repay around $8 million of debentures that mature in April. St Lawrence's executive chairman and controlling shareholder Kevin Podmore told interest.Co.NZ that St Lawrence has the cash on hand to repay the debentures, but wants to push ahead with the office building developments in Wellington and therefore needs the cash injection to do that. Elsewhere, there's a debate raging over the liquidation of Money Manager's First Step Fund back in May 2006. A Wellington barrister is taking legal action on behalf of 7,000 investors who are owed $457 million. Matrix Funding, which is linked to Money Managers, has hit back at those claims. You can find out more by going to the rates blog on interest.co.nz. Meanwhile, liquidators have been appointed to two companies associated with blue chip investments. The companies collected rent and managed apartments for investors who bought those apartments in Auckland via blue chip. And in Australia, MFS Limited has hit more trouble. Its head of audit and risk has resigned for personal reasons, and it has said it may not be able to refinance $180 million worth of debt on its lifestyle and leisure division. That's bad news for debenture holders in MFS Pacific, who are hoping that MFS Limited would inject some cash to help a debt moratorium plan. I'm Bernard Hickey from interest.co.nz with the Daily Briefing. Catch you on Thursday.